Bitcoin fell by over $18,000 in November, the largest monthly dollar drop since 2021. That collapse triggered a wave of forced liquidations on leveraged bets, wiping out close to $2 billion in open positions over a short period. Then in early December, a fresh sell-off added another roughly $1 billion in leveraged liquidations, all within 24 hours. Headlines were screaming crash, fear, high risk. But beneath the chaos, there may be a far more important message to take away from this. Because while prices were plunging, something else was also happening. Global adoption kept accelerating. Institutions were still buying, and entire nations from the US to Bhutan were leaning into crypto in ways unimaginable just a few years ago.
We have gone from anti-crypto, especially in the US being the largest economy and largest, deepest capital markets in the world, to now President Trump saying that we will be the crypto capital of the world.
That was the CEO of Binance, Richard Teng. I spoke to him at Binance Blockchain Week in Dubai last week to ask him what happened in November.
What happened in November don't only happen in crypto, it happens in US equities as well, right? So for several reasons. One, there's a lot of leverage in the system, so a bit of de-risking, a bit of deleveraging is taking place. Secondly, with the US government shutdown, there's lack of data and macroeconomic conditions, such as whether there's going to be a Fed rate cut or not, whether it's on the table, off the table, that will impact trading patterns and sentiment as well.
Richard told me while this was happening in the short term, the adoption of crypto is actually increasing, and by more traditional institutions unlike before, with the world's largest asset manager BlackRock changing its stance and even partnering with Binance, signaling a major shift.
Less than 2 years ago, with 170 million users. Today, we are 300 million users. So you can see the pace of growth being very fast and very quick, right?
And he said AI and blockchain is going to accelerate that even further.
So you're going to see all those changes coming through, not only in the next 2 years, I would say in the next 5 to 10 years, a huge transformation coming through.
So is crypto crashing or is it the future? That's what we're exploring in this episode of Business Extra. And I'm your host, Salim Essaid. To help us understand all this, I'm joined by Yevgeny Bebnev, the Chief Investment Officer at Pelican Investments, who's been studying these shifts and believes we might be at a turning point with crypto. Yev, welcome to Business Extra.
Very great to be here. Thank you very much for having me.
You wrote an article for The National last week where you argue that November's sell-off hides a more resilient underlying story. Can you explain what that is?
I mean, look, in the article, well, first of all, maybe let me back up a little bit. I'm very much a macro guy by my sort of traditional finance roots when I was analyzing commodity markets, so supply, demand, and obviously the macro regime. My argument is quite simple. Crypto is now an institutional game. So if you had me maybe here half a year ago or a year ago, would be arguing over that. I think that argument is gone. Crypto is now a very much institutional asset, and therefore it's captured by the institutionalized inflows and outflows. It's a very much a risk-on, risk-off asset. So of course, as soon as you have some trials and tribulations in the bigger asset classes, crypto as an alternative investment asset class gets hit first. So it's much more of a sort of real-time barometer for the risk appetite.
So Richard Teng told me that the drop was driven by leverage, macro uncertainty, and sentiment rather than typical crypto fundamentals. Do you agree that this shows crypto is behaving more like a traditional institutional asset?
Yeah, absolutely. So IBIT, the BlackRock ETF, probably the biggest one. We have tons of other ETFs. So this is probably the first institutional access or the easiest one for the institutions to access crypto with. If you look at their size and the inflows, and these are quite transparent, of course, you will see that the amount of crypto they buy is orders of magnitude that any retail sort of ebb and flow can achieve. You can look at the likes of MicroStrategy. They hold over 3% of all of Bitcoin that will ever be mined. I mean, today, and whatever's left, I think there's maybe like 1 million left out of the 22 million that is a total supply. So yeah, it's very hard to say that your moms and pops, or let's say their kids in their basements rather, are essentially in the driving seat of that inflows and outflows that I mentioned earlier. So right now, the retail is much more in the backseat. They join when they can, when they see the news. Of course, when the liquidity eases in general, when the household incomes pick up. So we're talking M2 money supply. So basically, that's all the typical households liquid sort of cash and cash equivalent type cash. Yes, you can expect them to join the fray, but essentially, no, it's very much institutions right now.
And have we seen some big moves from institutions taking place this year that would really highlight this as a trend for 2025?
Yeah, I'm blanking on the exact amounts, but if you look at the last week's Bitcoin ETF, for example, through IBIT alone, I think that was in the billions or thousands of Bitcoins. MicroStrategy themselves obviously picked some up, and that is, I keep referring to MicroStrategy. By the way, I'd like to say that I'm not some sort of Bitcoin maxi. I'm on the fence on whether the MicroStrategy, for example, is doing net good or net bad for crypto or Bitcoin access, because you would think that it's a company and any company has operating costs, right? So if your entire job is to hold Bitcoin, then of course the argument sort of weakens in the sense that just again go into IBIT, which also has its own expense ratio, of course, but you could argue that it's cheaper. However, there's other things at play here. MicroStrategy, I would say, isn't the passive holder and accumulator here. I mean, they are reinventing the playbook. I mean, first of all, it's the infinite money glitch that they sort of pioneered, let's say, during COVID times. Now they're talking about collateralization and essentially like Bitcoin type bond structure. So they're moving towards a yield type, or in a corporate sense, a dividend type play, which I think makes sense. I think it's just a natural evolution. I think if you have a company to run, obviously you need to net for net, you need to create value. And if you then look at things like, was it Metaplanet in Japan, then there's a different reason why that one, for example, would go above the MNAV, basically the ratio between the stock and the underlying Bitcoin. For example, in Japan, Bitcoin is taxed at a different rate to corporate stocks, to equity stocks. So basically, it then becomes apparent. Then, of course, if you want to have access to Bitcoin, you want to pay tax. So it becomes a tax arbitrage. In Sweden, you have legislative kind of reasons for such a company to exist. First of all, it's a currency play, so people might want to be sort of indirectly exposed to the dollar value of Bitcoin, but at the same time, they have a very, again, it's going back to the tax regime, tax arbitration. So, for example, the pension funds, personal pension plans, I mean, they have a very sort of lucrative or very easy tax regime for anyone who uses their pension wrapper to accumulate, well, equities or, in that sense, an equity coin play. So, yeah.
Yeah, I see what you mean. I mean, it seems like institutions are adopting it more, I would say, across the board, but maybe they're doing it in different ways at the beginning, and we're starting to see that happen. And first of all, that is the reason why I spoke to you, because you are not a crypto or Bitcoin maximalist, which I appreciate, and I am looking for that more unbiased, not picking a side perspective. So I think that's really on point. And is the more institutional adoption of crypto going to affect volatility? Because that's usually the main criticism that people have of crypto. It can't be trusted, too many ups and downs, no regulation around it. Is institutional involvement going to change that?
I'm going to go a bit, probably on a bit of a tangent here, but the answer is essentially yes. If you look at what crypto is and how it works, first of all, it never sleeps. So the traditional stock markets, they have their bank holidays, they have their weekends. Whereas in crypto is 24/7, right? So even when you do your mark to market, and that is, for example, when a hedge fund marks their books, the profit or loss, they just pick a time in a 24-hour period, usually midnight, to mark that. Whereas in traditional asset classes, the stock exchanges close, and then that's when you have a small time window to mark that against. Mm-hmm. So if you accept that this is a 24/7, pretty much a real-time asset. I say pretty much because obviously it takes a few minutes to confirm each mine block, et cetera, et cetera. I won't get into the weeds of that. What is capital markets? Capital markets is essentially an arms race, right? So if you think of all of us as warriors in the battlefield, each one is trying to essentially win the battle, and winning the battle means making money. We are in it all together kind of thing. We try to test and probe somebody else's weakness so we can take their money from them. I know it sounds very malicious almost, but that's literally the point of capital markets. So in this arms race, and I'll probably go even further of a tangent, I'll give you an example. One that sticks out in my mind back in my commodities career days, and I'm sure a lot of listeners are hopefully old enough to remember, there was this big hedge fund called Amaranth, right? I think there were 6 billion or maybe 9 billion under management, something like that. And they had one star trader. That one star trader put on a massive gas position. It was betting on a certain sort of volatility curve in the gas pricing. And what happened is so that guy's name was Brian Hunter. It's a very well publicized case, so hopefully I'm not disclosing anything private here. But another very famous trader, John Arnold, and a philanthropist now, he was, I think, at Centaurus Energy, something like that. he has learned of this massive position by Brian Hunter at Amaranth. And he used his bigger size and tools and weapons, if you will, to try and push the market sort of and against Brian to basically squeeze him out of his position. And he's done that over weeks because obviously we're talking, again, it's not crypto, it's not real time. First of all, it takes weeks to learn somebody's position, then to affect it, et cetera, et cetera. The result was one of the biggest blow-ups out there in traditional asset classes because he pushed Brian Hunter into a margin call. I think by the time they unwound the position, they lost more money than the hedge fund was worth in its entirety. Where am I mentioning this? Crypto is almost a victim of its own success in that sense. It's real time, it's very transparent, right? If you go into, I don't know, Hyperliquid or something, you can actually infer quite a bit of various wallets' positions and start probing real time, very iteratively, very quickly, where somebody might be over leveraged or somebody might be lopsided in terms of their position, how you can push them in order to take their money. That's all that crypto is like. It's one of those strengths of crypto, in fact, is because things can get iterated very quickly. So now we have much more grown-up players who, instead of using bows and arrows again, I'm carrying on with my analogy there, instead of using bows and arrows to do the battlefield, they're bringing tanks. So the volatility is there and will be there. And I think that's basically, it's a feature, not a bug, to literally be a glimpse of what hopefully all of capital markets will be eventually once we tokenize everything and put everything on blockchain.
And does this differ than what happened in 2022, where there was a major crash, companies shutting down, as we know, the FTX and the like? And just want to understand from your perspective, are there similarities there, or what crucial differences tell us that this isn't a repeat of that?
I would say the 2022 is entirely different. This was driven by FTX. This is much more on the sort of traditional fraud side. Basically, one big company had a lot of clients' money. It not only did not segregate their accounts, they actually used them quite indiscriminately, something that has happened in traditional markets as well before. But this is your typical case of fraud. It's not actually like the way this has been done is actually nothing to do with the uniqueness of crypto. It's just one guy, let's say, went off a little bit of the moral compass track and it had this effect. So, of course, that precipitated the collapse of this biggest or one of the biggest crypto exchanges at the time. There was lots of write-downs, et cetera, et cetera.
Because, I mean, even with the FTX thing, it kind of created a chain reaction there, but it seems like to the point of the trend being institutional adoption, that now it's market factors that are impacting crypto versus that fraud and illicit type of activity in comparison. And looking forward, so one thing, again, when speaking to Richard Teng, the co-CEO of Binance, he was talking about how AI and blockchain are complementary technologies and they're going to transform fintech in the next decade. Do you agree with that? And what are the changes that you see that will take place with the technology?
I think, again, with AI and crypto, essentially, I think tokenization is going to be one of the biggest themes for sure. Again, it's already permeating pretty much any industry right now, of course, including banking. So we'll see much more of that, more assets being moved to a blockchain and tokenized, again, for ease of access, for real-time record keeping, and potentially being the sort of payment or, well, essentially currency, not just for the humans, but also for the AI. So the tokens we generate and how to encourage the AIs from becoming lazy, that might actually become the next thing as well. So tokenized energy, so to speak, for the AI to keep on functioning and getting more resources, because that's what they want, right? Your typical AI agent just wants to have more energy via tokens.
That's interesting. I mean, and if there was something that you would want to tell the crypto investor to keep an eye out for next year, what would it be? Not necessarily just technology, but what do you see in terms of 2026 outlook?
Well, again, right now, I think, first of all, we're at a low base, let's say, because of the correction. It's a bit like, sort of paraphrasing the ending of the article that I wrote for The National. If you're a trader, then just keep on looking at the charts and keep on trading and squeezing sort of the last penny out of your next trade, whether it goes up or down. But one thing that I'm constantly reminded of when we see this ups and downs and the next, oh my God, it's going down, it's all over, et cetera, et cetera. Look, I've been in crypto since 2013. I've seen this play out 1,000 times. I've bought Bitcoin below 1,000. I sold it at 30,000. I then bought it back at 35,000 to then short it at 16 and then go back. My point is it's so volatile. You have all these cycles, and yet every time we're getting the higher lows and the higher highs. So if you are an investor type person, just just size your risk appropriately. In the meantime, because we're at 91-ish today, I would say with all the institutional inflows, the downside is a lot more limited than it would have been in, say, 2022, when I think post-FTX collapse led us to somewhere around $16,000 per Bitcoin low. I don't think that's remotely achievable anymore, just by a function of how much money has been printed since, how much money has gone into the risk assets. So if you accept this thesis, then I would say the downside versus upside is very attractive from here, extremely attractive, I'd say.
Oh, that's a good comparison. And lastly, if we were to speak at this time, December 2025, but a year from now, December 2026, do you think we'll be able to say that crypto has officially entered the mainstream? Do you think that's going to happen? That's the growth that's going to happen in a year from now?
Oof, that's actually a loaded question, simply because it's currently a little bit geopolitically driven, and specifically US politics, I would say, because obviously it's the sitting president of the US that essentially made it mainstream this year. Assuming there is a little bit less of a fight between the Dems and the Republicans in the White House, and crypto isn't seen as, let's say, Trump's personal story or personal play here, and that doesn't cause a backlash against him, then I would say yes, absolutely. Crypto has, I'd say it's already entered the mainstream sort of institutional adoption, and I don't think there's a way back. I think we're past the point of no return. Even with the geopolitical part that I just mentioned, I still don't think we'll ever be back to, let's say, 2022 type environment.
Great. See, so we'll have to have this conversation again a year from now and find out.
I'll make a bookmark.
That's it for this episode of Business Extra. I'm your host and producer, Salim Essaid. This episode was audio engineered by Arthur Edison. Please make sure to follow and subscribe on podcast platforms so you get all the episodes as soon as they drop.